Hello, my friends, and welcome back to Boss Economics World, the only place that peels back the layers of financial propaganda to show you the ugly, beautiful, and profitable truth underneath. Today is September 3rd, 2025. While the mainstream media is busy chasing political soundbites and celebrity gossip, a silent alarm has just started blaring in the engine room of the global financial system. And trust me, the people who matter, the ones who move trillions with a keystroke, they hear it loud and clear. The rest of us? We're being told to ignore it. To move along, nothing to see here. Well, here at Boss Economics, we don't move along. We stop, we stare, and we ask the questions that make central bankers sweat. The headline that trickled out yesterday was so boring, so technical, that 99% of people scrolled right past it. Demand for Fed's reverse repo facility drops to 4-year low. 4-year low. It sounds mundane. It sounds like a statistic for nerds. But let me translate that for you from FedSpeak into plain English. The giant, $2.5 trillion emergency cash reservoir that has been propping up the U.S. financial system for the last 3 years has just run dry. It's gone. Poof. A financial ghost. The official number that crossed the wire was a paltry $21.07 billion. Let that sink in. Imagine a giant water tower built to protect a town from a drought. For years, it was overflowing, holding trillions of gallons. Now, you look at the gauge, and it's basically empty. And out on the horizon, my friends, the sky is looking awfully clear and the sun is beating down. The drought is coming. To understand why this is arguably the most important financial story of 2025, we need to take a little trip down memory lane. We need to understand what this reverse repo facility, or RRP, truly is, why it became a multi-trillion-dollar monster, and why its disappearance is the canary in the coal mine for your portfolio, your job, and the entire economy. So, what is this RRP? Forget the textbooks. Think of it like this: after the madness of 2020, the Federal Reserve, in its infinite wisdom, printed trillions of dollars out of thin air. They called it quantitative easing to make it sound sophisticated. It was the biggest money party in human history. But this created a problem. There was so much cash sloshing around the system that the big players, money market funds, government-sponsored enterprises, big banks had nowhere to put it. You can't just stuff $1 trillion under a mattress. They needed a place to park it overnight that was safe and paid a little bit of interest. Enter the Fed's RRP. It became the world's most exclusive, 5-star, all-you-can park valet service for cash. The deal was simple: give us your spare cash overnight, the Fed said, and we'll give you a tiny bit of interest and guarantee you get it back in the morning. And boy, did they park. At its peak in late 2022, usage of the RRP swelled to an astronomical $2.55 trillion. Let's be clear, that is not a normal number. That is the entire GDP of France, or the United Kingdom, just sitting idle, parked at the Fed every single night. It was the most visible symptom of the sheer absurdity of the Fed's money-printing hangover. It was a giant pool of excess liquidity, a financial term for money with no productive home. For the past couple of years, this giant cash cushion has been a source of stability. It was the system's shock absorber. But starting in mid-2023, that pool began to drain. Slowly at first, then faster and faster. From $2.5 trillion to $1 trillion, to $460 billion in June of this year, and now, to a ghost town of $21 billion. So, the billion-dollar, or rather, the trillion-dollar question is, where did all the money go? The money didn't just vanish. It was sucked out of the system by two giant, relentlessly powerful vacuums operating at the same time. And both are controlled by the US government. Vacuum number 1, the Fed's quantitative tightening, QT. This is the unprinting of money. The Fed is desperately trying to put the inflation genie it released back in the bottle. So, every month, like clockwork, it allows its balance sheet to shrink. It lets up to $60 billion in treasury bonds and $35 billion in mortgage-backed securities mature without reinvesting the proceeds. Think of it as the Fed running its money printer in reverse. It's a slow, methodical, relentless drain of nearly $100 billion a month. Over a year, that's more than $1 trillion of liquidity being permanently deleted from the financial system. It's financial death by 1,000 cuts. Vacuum number 2, the US Treasury's borrowing binge. This is the more aggressive and immediate culprit. Remember that political circus we had back in July? The debt ceiling fight? Well, Congress finally raised the government's credit limit, and Treasury Secretary Janet Yellen immediately went on the mother of all borrowing sprees. The government's checking account, the Treasury General Account, TGA, had been run down to fumes. To refill it, the Treasury has been issuing a tsunami of new T-bills, short-term government debt. We're talking hundreds of billions of dollars in new issuance. Now, here's the critical connection. Who buys these T-bills? The same money market funds that were parking their cash in the Fed's RRP. For the past year, this has been a relatively painless process. A money market fund would see a new, attractive T-bill from the Treasury. It would pull its money out of the RRP, buy the T-bill, and the money would flow from the RRP into the Treasury's TGA. On the surface, the money just moved from one government-related pocket to another. The RRP acted as the perfect buffer, absorbing the entire impact of this massive liquidity drain. But the buffer is now gone. The water tower is empty. The $2 trillion shock absorber has been completely used up. And this is where the real danger begins. With the RRP effectively at zero, the two vacuums, QT and the TGA refill, are now pointed directly at the heart of the banking system, bank reserves. Bank reserves are the cash that commercial banks hold at the Federal Reserve. It's not the RRP parking lot, this is the private, high-security garage. These reserves are the fundamental bedrock of the financial system. They are what banks use to settle payments with each other. They are the ultimate cushion against shocks. When reserves are plentiful, the system is smooth, liquid, and stable. When they become scarce, the plumbing seizes up. And the entire house floods. Does this scenario sound familiar? It should. For those of us who have been in the markets long enough, a cold shiver is running down our spine. It's the ghost of September 2019. Back then, the Fed was also doing a mini version of QT, and the Treasury was also issuing debt. Slowly, quietly, bank reserves were drained to a level the Fed thought was adequate. They were spectacularly wrong. In mid-September 2019, the system suddenly broke. The overnight lending rate in the repo market, the critical plumbing where banks lend to each other, spiked from around 2% to as high as 10%. The system froze. Banks didn't have enough reserves and started hoarding what they had. For a few terrifying days, the very circulatory system of American finance had a heart attack. The Fed, caught completely off guard, was forced to panic. They had to publicly humiliate themselves by intervening with massive, emergency liquidity injections, what they ironically called not QE, to unclog the pipes. The lesson was brutal. Nobody, not even the PhD economists at the Fed, truly knows what the minimum safe level of bank reserves is. They are flying blind. And today, my friends, they are flying blind again, but at a much higher altitude and with far more fuel on board. The officials will tell you not to worry. They'll point to the current level of reserves, standing at $3.2 trillion, and call them abundant. But abundance is relative. The US economy and the US national debt are vastly larger than they were in 2019. The post-2023 banking jitters, epitomized by the collapse of Silicon Valley Bank, have made banks far more cautious and hungry for liquidity. The rules, like Basel III, have changed. The abundant level of yesterday is the dangerously low level of tomorrow. Now, let's add a layer of classic political intrigue to this financial tinderbox. Who is it that's telling us everything will be fine? One of the loudest voices is Fed Governor Christopher Waller. He was just quoted saying he believes the US central bank could comfortably lower the level of bank reserves to around $2.7 trillion. This is the same Governor Waller who was reportedly on the short list of candidates being considered by former President and current candidate Donald Trump to be the next Fed chair. It's also the same Governor Waller who was publicly calling on the Fed to lower borrowing costs to cut interest rates at its meeting later this month. Do you see the contradiction here? It's a spectacular one. On one hand, the Fed's liquidity draining policies, QT, are continuing on autopilot, and the Treasury is draining even more. This is a tightening of financial conditions. This is what you do to fight inflation. On the other hand, a potential next Fed chair is calling for rate cuts and easing of financial conditions. This is what you do to stimulate the economy. It's a car with one foot on the brake and the other foot flooring the accelerator. It's a recipe for chaos. Is Waller trying to signal to a potential future boss that he'll be a low-rate guy? Is he trying to juice the stock market ahead of an election cycle? Whatever the motivation, the reality is this: the rapid drain of the RRP means that the drain on bank reserves is about to accelerate dramatically. JP Morgan's own analysts, hardly a bunch of fearmongers, noted last month that with RRP balances near zero, reserves are now bearing a greater share of the liquidity drain, setting the stage for potential funding pressures. That's Wall Street code for get ready for another September 2019 style blow-up. And what happens if we get a funding market crisis? It won't stay in the obscure corners of the repo market. The shockwave will hit everything. 1. Your mortgage: if banks are scrambling for cash, the cost of all lending goes up. 2. Your stocks: the market has been floating on a sea of liquidity for 15 years. The tide is now going out at a historic pace. Remember the old saying, when the tide goes out, you discover who's been swimming naked. 3. Your job: when credit markets freeze, companies can't get the short-term funding they need to make payroll and manage inventory. Economic activity grinds to a halt. So, let's put it all together. The multi-trillion-dollar RRP buffer that has been protecting the financial system is gone. The Fed continues its QT drain. The Treasury continues its TGA borrowing binge. Both are now sucking liquidity directly from the banking system's reserves. The Fed claims it has everything under control, just like it did in 2018 before the 2019 repo crisis. And a leading candidate to be its next chairman is calling for rate cuts, even as the conditions for a liquidity crisis are ripening by the day. My friends, the disappearance of the RRP is not the end of the story. It is the end of the beginning. It marks the transition from a painless liquidity drain to a very, very painful one. We are now entering the most dangerous phase of the Fed's monetary experiment. The talking heads on TV will keep feeding you the abundant reserves narrative. They will tell you it's all just technical plumbing. But the smartest people in the room are not watching the consumer price index anymore. They are watching the Fed's H.4.1 report every Thursday, looking at one number and one number only: reserve balances with Federal Reserve banks. They know that the Fed is playing a high-stakes game of financial Jenga, pulling blocks from the bottom of the tower. The structure is getting wobbly. Governor Waller thinks they can pull a few more blocks out. But one of them is going to be the block that brings the whole thing crashing down. So, as you go about your week, remember the ghost of that $2 trillion. Its disappearance is not a footnote, it's a headline. It's the final, quiet warning before the noise begins. Stay sharp. Stay prepared. And don't believe the hype. This is Boss Economics World, signing off.